You're about to watch your neighbor lose their house, not because of irresponsibility, but because they believe the lies everyone has been selling recently. Right now, in this video, a $12 trillion time bomb sits quietly in the American housing market. The fuse is already burning. Here's the number that should terrify you: 67%. That's the portion of the average American's net worth locked inside their home. One asset, all your eggs, one basket. And that basket is about to drop off a cliff quietly while most people remain unaware. I'm going to show you something in this video that mainstream news will never highlight. The pattern has repeated 3 times in modern history. Frame by frame, history is repeating itself. The Treasury absorbed $3 trillion in mortgage-backed securities in just 6 months recently, quietly moving the market. JP Morgan sold 40% of their residential mortgage holdings in Q3 of 2024. Smart money is already leaving while the public stays distracted. Deutsche Bank announced $1.2 billion in real estate derivative losses in November. These are choreographed exits, not random events, and you're holding the bag. By the end of this video, you'll recognize the stage we're in and why millions of homeowners may lose everything despite following all rules. Every financial collapse follows a blueprint I call the leverage ladder. 4 stages, same sequence, repeated over decades. Understanding it is critical to survival. Stage 1 is the foundation. Everyone feels wealthy. Asset prices rise month after month. Credit flows like water from a broken pipe. Your neighbor refinances for luxury purchases. Cousins with poor credit get massive mortgages. Everyone is winning. But borrowed optimism always comes with consequences. During 2021-2022, U.S. mortgage debt jumped $21 trillion. That's not growth. That's leverage. Eventually, someone will demand repayment and the cracks will show. Stage 2 is the trap. The public still celebrates rising prices, while insiders quietly prepare for exits. SEC filings reveal who is leaving first. CEOs from the top 12 mortgage lenders sold $487 million worth of stock in Q4 2024. Not diversifying, selling. They see what most ignore. High interest rates exist, but prices remain elevated. That gap is the trap. Think scissors, blades apart, with your neck right in the middle. Stage 3 is the trigger. Something small breaks. Experts dismiss it. In 2008, subprime mortgages were tiny. In 1929, margin debt was ignored. The trigger is almost always overlooked, too small to matter until it cascades. But once it spreads, it dictates the entire collapse. Stage 4 is the cascade. Time compresses. 10 years of leverage unwind in mere weeks. Forced selling, margin calls, and liquidity vanish like water. Houses aren't worth Zillow estimates anymore. Prices fall to what buyers are willing to pay during mass selling. That is usually far lower. History repeats. In 1926, Florida real estate speculation exploded. People bought swampland unseen, flipping properties before their payments were due. Everyone felt invincible. Then a hurricane hit. Buyers discovered half the land was literally underwater. Overnight, $1 billion in 1926 dollars evaporated. A regional disaster became systemic. Rural banks nationwide financed these deals. When the land became worthless, bank failures multiplied, creating a contagion before the stock market even crashed in 1929. Black Tuesday wasn't the cause, it was the symptom. Real estate debt had already poisoned the financial system, unseen until the stock market reacted. In 1928, wealthy insiders moved capital. JP Morgan shifted $60 million in gold abroad. The Rockefellers moved into treasuries. The average homeowner had no clue. They didn't lose their house immediately. Losses came when banks called mortgages early. Your home becomes the bank's emergency exit, not your personal asset. Fast forward to 1986. The savings and loan crisis quietly spread, killing institutions like carbon monoxide. Failure was slow but deadly. Market participants were unaware. Congress deregulated S&Ls, allowing risky commercial loans. Entire empty office parks were financed in Texas, purely speculative, with vacancy rates hitting 30% by 1985. Federal regulators knew in 1984, but buried internal memos showing nearly 500 insolvent S&Ls. They hoped to avoid panic by managing failures quietly. When the dam finally broke in 1989, taxpayers paid $132 billion. Over 1,000 S&Ls vanished. Homeowners were forced to deal with vulture funds. Those vulture funds immediately changed terms or initiated foreclosures. People who paid faithfully lost homes. Savings accounts funded the very bubble that destroyed them. Now, the 2008 crisis, Lehman Brothers, Bear Stearns, the Great Recession. Most think it began with subprime mortgages. It actually started in 2004. The SEC's net capital rule allowed investment banks to leverage 30.1 instead of 12.1. Suddenly, banks could gamble $30 for every $1 they had. Subprime mortgages were packaged into CDOS and sold to pension funds as safe investments, while banks knew they were risky. The system was engineered. Goldman Sachs created a CDO to an AC1. They sold it to clients while betting against it, making billions while clients lost everything. When the 2008 crash hit, 38 million Americans lost homes within 2 years. Not due to irresponsibility, but because the system was built on fraud. Post-2008, the problem wasn't fixed. The Federal Reserve printed $4 or $5 trillion. That money fueled more real estate debt, inflating a bubble larger than before. Now, 16 years later, the housing bubble is enormous. The market sits under a balloon, and someone has already pulled the needle. Stage 1, the foundation, ran from 2020 to 2023. Mortgage rates dropped below 3%. Housing prices rose 40% nationally. What appeared growth was actually a Ponzi scheme. A $300,000 house in January 2020 is supposedly $420,000 now. Yet, the Atlanta Fed reports median households spend 41% of income to afford it. Stage 2, the trap, is underway. Signs are everywhere. Yield curve inverted 18 months consecutively, the longest in history, signaling inevitable recession pressure. Japan raised rates after 17 years. This triggered the carry trade collapse. U.S. mortgage bond prices dropped 8% in 72 hours, forcing Fed emergency intervention. $1.5 trillion in commercial real estate loans mature by 2026. Office buildings are empty due to remote work. Defaults already triple historical averages. Liquidations will hit banks holding residential mortgages. Events are not disconnected. They are dominoes aligning for a massive cascade. Mainstream media watches unemployment and inflation. They ignore the derivatives market, where $210 trillion in contracts links banks globally. One failure triggers systemic collapse. Derivatives like interest rate swaps and CDS create circular promises. When one link fails, liquidity vanishes. Lehman Brothers 2008 proved this risk vividly. November 14, 2024, Deutsche Bank reported $1.2 billion in derivative losses. Not default, just cracks in the system. The first domino is falling. Dominoes continue. Mid-tier regional banks fail. Depositors panic. Bank runs now occur digitally, instantly. Credit freezes. Mortgages can't be funded. Housing dies quietly. Credit card defaults spike. Delinquency rates hit 3.1%, highest since 2011. Forced selling begins. Peak buyers with minimal down payments become underwater rapidly. Foreclosures surge. Overheated markets like Austin, Phoenix, Boise drop 20 to 30%. Banks mark mortgages to market. Lending freezes. Equity vanishes. Homeowners trapped. This time is different is a dangerous phrase. Regulations are outdated, designed for 1930s banks, not shadow banking systems controlling $52 trillion now. Equity averages mislead. 63% of mortgages since 2020 went to first-time buyers at peaks. When prices drop 15%, they're wiped out. Millions at risk. Corporate investors now own 7% of single-family homes. Fiduciaries don't hold for comfort. They liquidate fast, accelerating the cascade and panic selling further. Another objection, government bailouts. 2008 cost $5.2 trillion in total. Today, mortgage market is $12 trillion, commercial real estate $5 trillion, far beyond feasible bailouts. This time, the Fed can't intervene without crashing the dollar. Political will to rescue wealthy homeowners is absent. The system is more fragile than ever. Debt-fueled asset bubbles collapse when servicing costs exceed asset returns. That's the exact scenario today. The trigger is already pulled. The bullet is in flight. What to do? Calculate your true mortgage-to-value ratio. Be honest. Subtract 10% for falling prices. Above 80%, danger. Above 90%, time bomb. Build liquid reserves. Keep 12 months of expenses in cash. Not stocks, crypto, or home equity. Survival depends on accessible funds during credit freeze. Stress test your income. Can you pay your mortgage if you lose your job? Less than 6 months? Increase income, cut expenses, or sell early. Get a HELOC while available. Open credit gives options when banks shut lines down. Planning now ensures flexibility during cascade chaos. If stable, position for opportunity. Cascades create generational buying chances, but only with cash when everyone else is forced to sell. Timing is critical. Don't stare at ticker symbols. Measure, zoom out, and watch the plumbing of the system. The true signals lie in cash flow and leverage. Human nature repeats. Greed, denial, panic persist across decades. 1929, 2006, 2024. Technology changes, but psychology remains identical. Awareness is your defense. The Fed doesn't protect homeowners, they protect the system. If your loss stabilizes the system, that's the trade. 40 million homeowners may stand in its path. Stand aside or risk destruction. This video reveals the blueprint, not speculation. Documented history and real numbers guide survival strategies during cascading events. Part 2 will reveal which markets crash first, one bank signal indicating the cascade has begun, and the single asset class that gains during collapse. Subscribe and hit notifications. When this breaks, information will arrive too late on mainstream channels. Early awareness is your only advantage. In every crisis, wealth transfers from unprepared individuals to those who anticipate patterns. Understanding the leverage ladder ensures you are on the right side. Don't underestimate this sequence. Past events are proof. The market obeys math, not hope. Timing, liquidity, and preparation are survival tools during systemic collapse. This video gives clarity. Watch closely, analyze, prepare. Don't wait until the cascade begins. Knowledge now is the only insurance against systemic devastation.